Former New York Times reporter and author Gary Rivlin will be in Missoula Wednesday to speak at a day-long conference about consumer protection. Rivlin's latest book is titled Broke USA, From Pawnshops to Poverty Incorporated, How the Working Poor Became Big Business. His research included an in-depth look at the payday loan industry. In tonight's feature interview, Rivlin talks with news director Sally Mauk about a world he describes as upside down.
You needed customers, the payday lender, the pawnbrokers, the rent-to-own people needed customers who had no money in their pockets rather than having a lot of money in their pockets. And I just was really interested in looking at these controversial industries at a time it was going to be boom time for them, even though it was hard times for everyone else. And I was really interested, who are these people? Who came up with the payday loan? Who was behind the subprime mortgage? So I really wanted to find these people and figure out what makes them tick.
And one of the people you found and discovered what makes him tick is Alan Jones, who you call the payday loan pioneer.
Right, so Alan Jones is someone who's gotten very, very wealthy from the payday lending industry. He's making about $20 million, $25 million a year these days on payday loans. And, you know, he inherited a debt collection business from his dad, and things were proceeding well. He was building it into a nice-sized business. And suddenly he comes across this guy in Tennessee who was offering these quick loans against someone's paycheck. You know, you've run out of money, you still have some bills, you're not getting your next paycheck for a week. And so this fellow was making loans against the paycheck, and the light bulb went off in Alan Jones's head and realized that, wow, this could be a big business. And, you know, 13 years later, there were more payday lending stores in the U.S. than McDonald's and Burger King's combined. This industry just took off.
There's a saying among those in the industry which you quote, and the saying is this: a banker may want 100 customers worth $1 million. The payday lender likes to say, but we prefer 1 million customers, each worth $100.
I think the shame of all of these businesses, whether it's pawnbroker, the payday lender, auto title lending, which is big in Montana, is that if people just had a savings of $500, they can loan money to themselves. The typical payday loan is $325 across the country. The average pawn loan is only $90. And the fees that people are paying work out to an annual percentage rate of 400, 500% for the payday loan, a couple of 100% for the pawn loan. And so if people could just essentially borrow from themselves, dip into savings to cover their emergencies. But, you know, the problem is that real wages are stagnating over the last 20 years among the bottom half as rents, heating oil, health insurance, all sorts of expenses go up. So it gets harder and harder and harder to make ends meet, and that's why these businesses are doing so well. That's why there were $40 billion in payday loans last year, $200, $300, $400 at a time.
As you said, it's a customer base with a, quote, sense of desperation and few options.
Right. So the one thing I will say, or among the things I'll say in defense of the payday loan is it's a transparent transaction. You know, with subprime loans, subprime mortgage loans, we heard a lot about bait and switch. We heard a lot about hidden fees, deceptions. That's not a payday loan. You walk into most stores, and it's kind of like a fast food restaurant. The prices are posted right there. But even though it says that for the $20 we're going to charge you for every $100 you borrow, and that works out to an annual percentage rate of over 500%, people see that. But when you need money, you need money, and you'll worry about how you're going to pay that fee on the other side, and that's where it really starts to become a trap. Even spokespeople for the industry acknowledge that typically it takes 2 or 3 months to pay back one of these loans. So you're not just paying a $20 fee for 2 weeks, you're paying it over and over and over again until you can pay back this loan. Half the typical customer, according to academics and the consumer advocates, owes a payday loan for half the year. Again, if you're talking about annual percentage rates of 400% or 500%, if you're borrowing $500, you're paying $1,000 in fees for that same $500 you're borrowing, paying back, borrowing, paying back. 1 out of 5 customers is owing a payday loan for virtually the whole year. And so again, now you're, instead of paying $1,000 in fees, you're paying $2,000 in fees on that same $500 that you can never quite get ahead and pay off.
Is this a necessary evil? In other words, as you say, these are people who've run out of money to buy groceries. They maybe don't have another option. Maybe they have bad credit, can't get a loan from a bank. What are they supposed to do?
Yeah, I mean, I started off this project a couple of years ago thinking exactly that. What do you do if you don't have a rich uncle to hit up for money if your car breaks down? What do you do if you don't have a credit card? But a couple of things. One, the payday loan leaves you worse off rather than better off. There's a woman in Dayton, Ohio, I quote, who says the payday loan is to bridge a gap, but the problem is the gap gets wider and wider and wider. This person who's so desperate for $300 today that they're willing to pay an annual percentage, the equivalent of an annual percentage rate of 500%, how are they going to have the extra $360 in 2 weeks above and beyond their usual expenses? So you just keep on rolling it over and over again. And the other factor is even though these are promoted as emergency loans, they're not being treated as such. They're being marketed by the big payday lenders in ways that don't treat this dangerous financial product any different than a bar of soap. One big chain I write about, if you haven't been in their store in 60 days, they'll call you to try to induce you to get back in. And I'm thinking, like, wow, this is an emergency loan, but you're soliciting. They're creating some demand. Every chain offers $20 off your next payday loan if you bring in a family member, a coworker, a friend. Some of the payday lenders have deals with the local auto mechanics and doctors' offices. Have people who are having trouble paying back your money or paying you the money they owe. Send them to us. We'll give you a little bit of a kickback. So, if we're going to have payday loans, I think we need to monitor them much more closely, limit it to one at a time. There's so many people in this country who have 2 or 3 or 4 of these at a time, and once you owe thousands of dollars to a payday lender and you're paying this kind of interest, it's almost impossible to get out of it. So, yes, there is a real demand that they're meeting out there, but there really has to be a much more forceful regulatory arm dictating how many loans, what the rates are, and other provisions.
It's interesting that you found that more women than men get these loans.
Well, I think there's a lot of single moms struggling to get by, and the father isn't giving the payments, the child support payments on time. And some of it too is just generally a lot of women are running the household financially, so they're either a single mom or in a couple doing it. But yeah, the same with rent to own, the same with some of these other industries. I was surprised by that.
Your book is not just about the payday loan industry. It also looks at pawn shops and check cashing spots, and it is truly an industry based on poverty. I mean, this is an industry that when the recession is at its worst, they're doing their best.
Right. That's what I meant before about it's this upside down world. It's not across the boards true. There are more people going to Rent-A-Center and the other big rent-to-own companies today than were a few years ago. The payday lenders, there are 7 publicly traded companies in the payday lending business, so you can see, how they're doing. And yes, traffic is up, but the check cashers, less people with jobs is bad news for the check cashers. Something interesting about the check cashers, and here's another area where I just wonder if there just needs to be more regulation. I'm sitting here in New York where they cap the rate you can charge for cashing a check at 1.8% of the face value of that check. If I was in Georgia, it'd be 5% of the face value. But 1/3 of the states in this country, including Montana, have no cap on the fee a check casher can charge to cash a check. And just think about that. Someone making $20,000 a year, they're paying, $400 to cash their checks, their paychecks here. In New York, they'd be paying $1,000 in Georgia, but the sky's the limit. It's almost like in a Montana or 1/3 of the state. It's almost like there's a a poverty tax out there for those who have messed up their relationship with a bank. They can't have a bank account. They don't trust banks, or more typically, they've bounced too many checks and the banks have cut them off. And once that happens, they're giving 5% more of their paycheck to the check cashers and paying a fee every time they want to pay a check. They owe the landlord, they owe the utility companies. They're paying typically $2 a pop to pay their bills.
There is in Montana, as elsewhere around the country, a growing awareness of this industry and efforts to do what you suggest, which is to cap those rates.
You know, it's interesting, but I follow the industry, the payday industry, blogs and such, and there's a lot of attention being paid to Montana. Every year there's one or two or three states that reconsider the permission they've given payday lenders to do business within their states. Maybe they should cap the rates, maybe they should kick them out. And now all eyes in the industry are on Montana with the big ballot initiative in November. 2 years ago it was Ohio and Arizona. And so what we're seeing in the last several years is states that said they gave a exemption from the existing usury cap. Most states have a cap on the interest rates that a lender can charge, but the payday lenders spent a lot of money on political contributions. They hired lobbyists and successfully made the case that, well, these are short-term 2-week loans or emergency loans. They shouldn't have to abide by the existing cap on interest rates, and that's what allowed them to thrive over the last 15 or so years. But now states are starting to reconsider. About a half dozen states in the last few years have capped interest rates that the payday lenders could charge, just like Montana is considering right now.
We have been speaking with author Gary Rivlin, whose latest book is called Broke USA, From Pawn Shops to Poverty, Inc., How the Working Poor Became Big Business. And he will be participating in a one-day conference on consumer protection issues sponsored by Attorney General Steve Bullock this Wednesday at the Doubletree Hotel in Missoula. Mr. Rivlin, thanks very much for speaking with us today.
Thank you. My pleasure.
For more information about the Wednesday conference, go to the website www.consumerprotection.mt.gov.